Hello, I'm David Cassidy with the midweek update. Today, Wednesday, the 18th of November. With the US presidential election effectively settled, coronavirus is again the main driver of global equity markets. As such, equity market volatility has remained elevated thanks to the continuing tug of war between increasing coronavirus infections and the risk of tighter lockdown restrictions on the one end and coronavirus vaccine developments and the potential for further economic stimulus on the other. For example, on Monday, Moderna, a US biotechnology company, announced that its coronavirus vaccine was 94.5% effective. And this, taken together with last week's positive news from Pfizer, helped equity markets continue their sharp rally, especially as Moderna's vaccine has fewer logistical challenges than Pfizer's vaccine. However, those gains have been pared slightly both today and yesterday, the 17th of November, after lockdown restrictions were reimposed in a number of US states. Despite the fact that we have a challenging few months ahead, given the number of rising deaths and the near-term challenges for hospitals as we approach the winter period, we believe that vaccine optimism will win out, given the potential for economic normalisation sometime in 2021. Now, while our optimism may be considered premature, given it will take time to roll out a vaccine, meaning that we must continue to live under a coronavirus sword of Damocles, there is, thankfully, light at the end of the tunnel. In fact, we believe that it is actually only a matter of time before a strong and sustainable economic and therefore stock market recovery is in full swing, especially given the political aversion to severe lockdowns. I mean, even Joe Biden's advisors think that a nationwide lockdown is too blunt. This, coupled with the fact that interest rates will remain low now for many, many years to come. Furthermore, economic data so far this week indicates that the global recovery is still ploughing ahead despite this rise in coronavirus infections and localized lockdown restrictions. Chinese factory output, fixed asset investments and retail sales all rose, while the jobless rate fell. Japanese Q3 gross domestic product grew at an annualized rate of 21.4%. And although the US retail sales reading for October came in a tad lower than expectations, suggesting perhaps that the recovery is moderating, its year-on-year increase was still very impressive at 6%. However, despite this, unfortunately, in the very near term, we will continue to take 2 steps forward and 1 step back as equity market volatility is likely to remain elevated.